just happy everybody's joining. This is, I love what I do. I love this stuff. I can't
That's good to hear.
complain, you know.
I think Adam's decided he wants to be in television.
Oh,
He's going to give up this real estate stuff. He's going to be a TV host.
nice.
It's with my name, I wish I could be a rock star. Fortunately, I'm this here. So I guess we could start. I know we're missing some people, but we give them a few more moments. Let me shoot a text message. Hold on.
Usually 10, 20, 50, they can get pretty massive, and you don't really see these types of deals with wholesalers. So, there's kind of silver lining at that point, because I think we're able now to really focus on acquiring large amounts of units instead of focusing on one-offs with wholesalers. So that's kind of the direction that we're pivoting in, focusing more towards portfolios. And I wanted to go through and kind of tell you the due diligence process for portfolios specifically. So I really separate it into kind of two components, just to not waste my time or anyone else's time. The first one, like I call it like primary due diligence, is mainly just the financial aspect. Because if the finances don't work, then the secondary part doesn't even matter. So there I'm really focusing, I really have to understand what the ARVs are for the neighborhoods, what the rents are, all of our operating expenses, etc. And to get to that point, I kind of want to go back to the importance of knowing what your end product is going to look like. Because I think that that's one of the big mistakes that people that are first starting out do. They overestimate what their ARV is, because if you go in West Philly, it's very exciting. You're seeing properties that can break past $200,000, and you're thinking, wow, I can get this property for 50, put in 50, it's going to be $200,000. And it doesn't necessarily work that way. You have to be very familiar with your end product to know not only the ARV, but what your rents are going to be. So for us, mainly, I know that, I would consider us to be kind of like a high grade rental. So we don't have, marble countertops or finished basements, but we have, really nice open finishes, open concept, laminate flooring. Everything looks really,
which I just was so utterly depressing walking through and seeing the condition that these people were living in. So that was fun one. And what we found is that it was really difficult to find enough of them to make it worthwhile. To find a dozen properties took us like a year. It was ridiculous. It was not scalable. It wasn't something I could build a business on. So what we did from Fund 2 on is we went and we looked at product that many of which has been lightly renovated, that's in livable condition, that are much higher quality than the vacant product that we were looking at before, and that have renters, most of which had a minimum or a maximum, I should say, of 6 months remaining in the lease term, so that we could kind of let those leases mature and then go in and do the renovation. Not a complete gut renovation, because we wouldn't need to. So it's a slightly different model than Fund 1. And what we found is, as you can see from, Luis's, 51 units, he's got a 45 unit, he's got a 22 unit, he's got an 11, there's a lot of product out there. We can conceivably within the course of this year, buy our target minimum of, 200. So.
All right. That's for all funds or?
Correct.
Okay.
Correct. So Fund 3 is likely somewhere between 50 and 60. I'm kind of sitting on my hands right now, because we sent out an email on Sunday, and so far I picked up 3 investors on Sunday for $300,000 just that day. So I'm sitting for a couple more days. It's better for us. The more units we have, the more diversified we have, the more insulated we are against, issues that may come up on any given properties. So